Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, the trade standoff between the US and China just got interesting to everyone except the financial markets. It is Monday, and the key bit of news is what hasn't happened. China hasn't retaliated yet to the sharp rise in US tariffs imposed on Friday, which went on to $200 billion worth of goods, taking a 10% rate up to 25%. This imposition hasn't actually seemed to derail the talks themselves. They've wrapped up now, but both parties have agreed to meet this week in Beijing. Equity, bond and currency markets have also all reacted as though nothing significant has happened and things will be resolved soon. China's necessary countermeasures haven't been imposed, not yet at least. The US itself has pushed out the timeline, saying China must agree to what it wants within a month or face tariffs on all its exports to the US. In the meantime, the higher tariffs apply to the $200 billion, and of course it is the American importer who has to pay them and pass on the costs to the American consumer, and that is an extra $50 billion in cost. China exports about $500 billion per year to the US, or 20% of all of its exports. The US exports about $120 billion per year to China, or about 10% of all its exports. It seems the Chinese don't see the current state of these negotiations as a breakdown, just an expected bump. And so far, the financial markets seem to agree. Interestingly, iron ore prices are back up to their recent highs, and coking coal prices have also been rising recently. These are not signs of fear in China, even if you discount the Shanghai equity price rise as a result of instructed SOE buying by the national team. Consumer inflation in the US has come in slightly less than expected, but right on the Fed's 2% target, and slightly above on a core basis. That's without food and petrol. The April update to the US federal monthly budget shows expanding deficits. For the 12 months to April, this deficit is $924 billion. It is conceivable to rise above $1 trillion in the current fiscal year, way earlier than expected. And compared with the $779 billion last year and the $529 billion in the last year of the Obama administration, when it was apparently political evidence of fiscal mismanagement. The Trump administration looks like it will double their deficit in just one term. And in that period, the deficit has gone from 2.7% of GDP to 4.8% of GDP. And by the way, that $50 billion in extra tariff income will hardly touch the sides of this deficit. The trade spat is one reason the US deficit could get worse quickly. The Agricultural Secretary said bigger, longer subsidies for farmers are on the way to prop up that sector. US grain stocks are surging as exports fall. That's according to USDA's own reports. Other large production countries don't have that problem. In Canada, over the weekend, they reported strong jobs growth, with more than 106,000 new jobs gained, and by far the most of them full-time jobs. Their participation rate improved as well. It was a result that was much better than expected. In fact, it is their best jobs gain in more than 40 years. In Europe, German exports rose to over $118 billion €118 billion in March, catching analysts by surprise at the gain and cementing a strong gain for the first quarter. German imports rose even more strongly. This is data that doesn't fit the narrative of global trade in trouble. And Indonesia says it wants to import more beef from Argentina to reduce what it says is an unreasonable reliance on shipments from Australia and New Zealand. And in Australia, a new election promise has been launched by the coalition government, promising to guarantee the deposits of first home buyers who have at least 5% deposit, but less than the 20% that would help them qualify to borrow to buy. Would only be available for couples with an annual income of $200,000 or less, and is expected to cost the taxpayer $500 million. It is also likely to sharply raise the risk of going underwater quicker. US Treasury 10-year yield is now at 2.47%, and that's 6 basis points lower in the week. We'll be keeping an eye out on the US Treasury bond yields, because it is being suggested that China may be able to retaliate effectively by decreasing exposure to this market, effectively pushing up US benchmark interest rates. Gold is at $1,286 an ounce, and US oil prices a little changed today, now just on $61.50 a barrel, while the Brent benchmark is on $70.50 a barrel. And the Kiwi dollar is little changed today at 66 US cents. On the cross rates were unchanged at 94.2 Aussie cents. And so against the euro, we're similar at 58.8 euro cents. That all makes the TWI little changed at 70.6. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.